Hello, welcome to lecture 4 of module 5 in continuation with the models used by considering different financial ratios to talk about different financial parameters. Next in the line, we are going to have deliberations on bankruptcy model and its prediction. Now, when you are going to talk about bankruptcy or financial distress, we all know that the users community, specifically the providers of capital, the bankers, the financial institutions, the credit suppliers, the investors are more interested to know what is the likelihood or the probability of financial distress to which a company may be exposed to. So, the use of financial ratios can be made to dig out the likelihood or the probability of financial failure or bankruptcy at the end of the company. To delve into that, Professor Edward Altman devised a model way back in 1968 for publicly manufacturing companies, and they created a model to dig out and to predict the likelihood of financial distress or bankruptcy at the end of the body corporates. In this lecture, we are going to have deliberations with regard to the model, its components, different ratios and the decision making criteria, followed by the further model propounded by Olson in 1980, which is also equally used in the corporate world to predict the likelihood of financial bankruptcy, but the technicalities associated with both these models are different. So, to start with, we are going to take off Edward Altman's bankruptcy model, which is more popularly known as Altman Z-score model. In essence, when you are going to talk about Altman bankruptcy model, Altman has proposed a model to quantify the Z-score, which is going to show the likelihood of bankruptcy at the end of the body corporates. When we are talking about the financial failure, we all know it is not because of a particular financial parameter or matrix. Rather, it is the cumulative effort of many different financial variables and forces which may lead a company to a state of financial distress. So, in order to address the likelihood of financial bankruptcy, obviously we are going to make use of different ratios and combinations in order to talk about the state of financial bankruptcy to which a business may encounter down the line in a future span of time. Now, one of the most often used predictive models for determining a company's chance of going bankrupt is the Altman's Z-score model. It forecasts a company's financial difficulty using a variety of financial measures, and it was created in 1968, and it is particularly helpful for examining the financial standing of manufacturing companies. As I said, there are different typical characteristics associated with different companies. When you are going to talk about publicly manufacturing companies, they exhibit a different characteristic so far as financial aspects are concerned compared to the trading companies who are backed by a different financial orientation. So, this model is specifically accommodating the manufacturing companies and their likelihood of bankruptcy down the line in a future span of time. Moving further, when we are going to talk about Altman's Z-score model, the model has been propounded on the basis of a statistical background which we technically call the multivariate discriminant analysis. The multivariate discriminant analysis is one of the popular technique used in statistics to discriminate with regard to different variables and its impact. We all know that there are a bunches of financial variables used to express different aspects of finance. But the question remains, when you are going to talk about financial bankruptcy or financial distress, does all the financial ratios equally contribute to predict the financial distress? Obviously, the answer is no. But on a subjective note, if you are going to say and decide that this ratio is going to contribute towards financial distress prediction, that ratio is not going to contribute towards financial distress, and so on and so forth, it is not a scientific approach to get a prediction of the financial distress. So that is the reason why Professor Altman developed this model by using the statistical technique, which is popularly the discriminant analysis, which statistically discriminate the use and application of different financial ratios while predicting the extent and magnitude of financial bankruptcy at the end of the corporate world. The discriminant analysis used by Professor Altman was on a multivariate platform owing to the simple reason that there are more than one ratio which have been used by Professor Altman to predict the bankruptcy and its likelihood. So, the starting point of Altman's model is to develop a bankruptcy orientation by considering different variables in the form of financial ratios, and Professor Altman propounded 5 substantial ratios which are contributing significantly to predict the bankruptcy to which the body corporates are exposed to. To start with, the model goes like Z is equal to 1.2 x1 plus 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus x5. These coefficients like 1.2, 1.4, 3.3, 0.6, 1, they are more or less the outcome of the discriminant analysis, and these are the weights, or you may say the coefficients of the variables x1 to x5, which represents 5 formidable ratios which are exclusively contributing towards predicting the likelihood of bankruptcy at the end of the body corporates. Now, with regard to the ratios, let me unfold it. X1 stands for the causal relationship between working capital to that of total assets, X2 retained earnings to that of total assets, X3 earning before interest and tax to that of total assets, X4 market value of equity to total outside liabilities, and X5 is sales to total assets. If we go for a deep dive into these 5 formidable ratios, we can easily make it out that here we have considered almost all the dimensions of finance which have a bearing with regard to the financial soundness of a company down the line in a future span of time. Taking the first one, that is working capital upon total asset. When you are going to talk about a causal relationship between working capital upon total assets, obviously we are there to see whether the working capital is sufficient enough to facilitate the use of total assets or not, because we all know when you are going to make use of the asset base in order to perform different activities on a recurring basis during the business orientation, obviously we need to have sufficient liquid cash to meet the immediate financial requirements. So, this is establishing a relationship between working capital in one hand and the total asset on the other hand. Moving further, when you are going to talk about a causal relationship between retained earnings to total asset, obviously It contributes again to the likelihood of bankruptcy, or in other words the financial soundness, by saying that how much of retained earning is made available vis-a-vis the total asset on which the business is based on. It is simply explaining the fact that if there is any need of further assets down the line in a future span of time to magnify the productive activities of the business, whether we are having sufficient return earning to finance those additional requirements of assets or not. If we do not have those heavy quantum of return earning, we have no choice but to knock the doors of outside sources of finance, and it is going to magnify the extent of financial risk. Then moving further, the third ratio, that is EBIT upon total asset. It is one of the most critical ratio which contributes towards the financial soundness, and in other words, on a negative connotation, we may say it is very sensitive to dig out the likelihood of the bankruptcy or financial distress at the end of the company, because we all know that if a company fails to generate sufficient operating revenue by utilizing the total assets, obviously in a span of 2, 3, 4 years down the line, the company will be into a state of financial distress, owing to the simple fact that the company fails to generate proportionate revenue to suffice the asset base and make different activities the way it is expected to be performed and executed. Moving further, the fourth ratio establishes a causal relationship between market value of equity to that of total outside liabilities. When you are going to talk about market value of equities, we all know that it is calculated either by using the financial statement or by using the market dynamics. The most popular modus of calculating the market value of equity is by picking the price at which the equity shares of a company is traded in the secondary segment of the stock exchange, and it is to be multiplied by the number of shares outstanding in order to calculate the market value of the equity in totality, and the market value per equity share is the price at which it is traded in the market. Now, as because we are establishing a relationship between market value of equity to that of total liabilities to outsiders, here indirectly we are considering the total market value of equity which is floating in the market. Now, this ratio is also equally sensitive because market value of equity is a mirror image about the financial soundness of a company, and obviously we all know that the investing class, they are very sensitive towards the price at which they are going to execute an act of investment. They are always into the protocol of digging out whether the price at which it is traded in the market is underpriced or overpriced, simply implying that whether the intrinsic value of share is higher compared to the market price at which it is traded or lower. So, it is one of the sensitive ratio which again contributes towards predicting the state of bankruptcy of a company. Then the last financial metrics or the ratio which is propounded by Professor Altman is a relationship between sales to that of total assets. We all know this is nothing but the asset turnover, because when we are establishing a causal relationship between sales and assets, indirectly we are going to dig out how efficiently and effectively the assets have been utilized in the business, which creates revenue in the form of sales by facilitating that selling activities of the business. Now, the combined use of these 5 formidable ratios leads to the prediction of bankruptcy or the probability of bankruptcy at the end of a company. Moving further, when you are going to talk about the Altman Z-score model, there are decision criteria extended by Professor Altman, by comparing which we can be in a state to say whether there is more likelihood of bankruptcy at the end of the company, or there is moderate or there is low. So, the decision criteria goes like this: if the value of Z calculated by using that composite model is going to be more than 2.99, then we may assert that the company is in a low risk of bankruptcy, or in other words, we may say that the financial soundness of the company down the line in future is going to be intact. The company is having less probability to be into a state of bankruptcy if the Z score is more than 2.99. Then there comes the in between orientation, that is, if the Z score is 1.81, less than 1.81 and less than 2.99, then it is in the gray zone. Technically speaking, if the Z score lies between 1.81 to 2.99, there is moderate probability that the business may end up into a state of bankruptcy. But the closer the value of Z towards the left tail, that is 1.81, the higher would be the probability or likelihood of bankruptcy, and the closer the Z score is towards the right tail, that is 2.99, the lesser will be the likelihood of bankruptcy so far as the body corporate is concerned. Then there comes the third decision criteria: if the Z score is less than 1.81, it leads to a state of distress zone as propounded by Professor Altman, which implies that there is high likelihood or higher probability that the company will end up in a state of bankruptcy down the line in 2 consecutive span of years. So, when we look at the decision criteria, there are a lot of contentions with regard to these theoretical values, but the Altman is of the defense that if we are going to talk about publicly manufacturing companies, this parameters or these benchmarks as propounded by Professor Altman works well to dig out the likelihood or probability so far as the body corporate is concerned. Now, Altman's model can also be used in a customized manner for different privately managed companies, other sectors also. Like in the introductory orientation, I told that Altman's model has been propounded by targeting publicly manufacturing companies, but there are also extensions of the Altman Z-score model, which is more popularly known as Zeta model, which is accommodating almost all the types of businesses, may it be manufacturing, may it be trading, may it be the services sector per se. So, I am not delving into the Zeta model in this section, owing to the simple reason that it is one of the restricted orientation so far as its use and application is concerned, but on the contrary, this Z-score model is freely available at the disposal of the users community, so that they can be in a position to dig out and predict the likelihood of bankruptcy of companies before executing any financial decisions in an informed and rational way. And the Z-score model contributes quite significantly to the financial decision making process, because we all know when we are going to talk about the finance and its states of affairs so far as a body corporate is concerned, we know that the most critical threat to a business in terms of finance is the financial distress or the state of bankruptcy, because that is the point of no return. If any company is almost approaching to that particular state, pragmatically it is not viable to come out of that particular situation so easily. There may be some odd man out situations or instances or experiences where a company has gone into a state of bankruptcy, and by taking different proactive measures and doing some fantastic policy decisions. There may be prevalences that the companies come out of that state of distress, financial distress, but in general when you are going to talk about financial distress, mostly we encountered situations or instances where it is rather very difficult on the part of the company to overcome that particular state once they are within the grip of bankruptcy, because bankruptcy is a state in the financial affairs when all the financial variables are going to behave in an unfavorable orientation. There will be decline earning before interest and tax, there will be heavy prevalence of assets, but the assets are not used efficiently and effectively to generate sales and to generate revenue. There is the shortage of working capital to meet the day to day recurring expenses. Then there comes the non availability of the accumulated profit in the form of retained earning, so far as taking up different liquidity projects or financing additional requirements of assets to be used in the business and so on so forth. So, put it together, when you are going to talk about the state of bankruptcy, all the financial parameters, all the financial matrices are going to be adverse at the end of the company. So, it is not that easy, rather we may say, if you are going to be on a positive note, it is neither, we cannot say that it is impossible for a company to come out of a state of financial distress, but pragmatically it is a very difficult task to come out of that, and it is going to influence all possible financial decisions so far as a body corporate is concerned at the end of the users community, like the creditors who are taking the decision to supply different goods or services on credit terms. Similarly, the providers of capital, whether they are providers of debt capital or they are providers of equity capital. Then similarly, the bankers who are more or less into the protocol of extending short term finances to meet the working capital requirements at the end of the company. So, all these decisions are going to be at halt, owing to the simple reason that if they will come to know that there is more likelihood of bankruptcy at the end of the company, then they will squeeze themselves, they will not come forward to conduct any activity with that business who is having a higher likelihood of bankruptcy, so far as the apprehension or so far as the uh, issue related to the financial states of affair is concerned. So, bankruptcy model propounded by Altman has been extensively used as a celebrated one since long, since its proposition way back in 1968, and there are different, as I said, cosmetized variations of the same model in the form of zeta analysis, which have been made applicable to all the forms of business irrespective of manufacturing or trading or services sector. So, it is extending its use and applicability by the passage of time, and it is contributing significantly to facilitate different financial decisions backed by varied objectives at the end of the users community per se. Moving further, when you are going to talk about bankruptcy, there are contentions with regard to the statistical background on which the Altman model was developed. The discriminant analysis carries a different logic, and based on the statistical outputs, we are in a position to say that this particular financial ratio is contributing less, that particular financial ratio is contributing more, and so on so forth. But there prevails other statistical techniques through which the bankruptcy can also be predicted. So, to do so, here I am going to discuss an alternative to Altman's model, which is going to cater to almost all the types of business organizations, may it be manufacturing, may it be trading, may it be services sector, may it be public, may it be private, irrespective of their typical characteristics, Olson's model is going to fit into all the characteristics so far as the state of financial distress or bankruptcy at the end of the corporate world is concerned. Now, the Olson model developed by James Olson in 1980 is a statistical model used to predict the probability of bankruptcy using logistic regression rather than a linear formula like Altman's Z-score. Now, when you are going to talk about the statistical background, as I said, in case of Altman Z-score model, it is the discriminant analysis, and Professor Altman created a linear relationship between and among all these financial ratios to predict the likelihood of bankruptcy of a body corporate. But James Olson came out with an alternative orientation by applying logistic regression instead of simple linear regression to predict the financial bankruptcy of a particular company. So, the logistic regression is operational on odds ratio, where using a binary orientation by saying that either the company is going to be safe or the company is going to be in a state of turmoil. So, based on that particular logic, when you are going to look forward, we are going to be prospective so far as the financial soundness of a company is concerned. Either we are going to come to a conclusion that the business is going to be safe after 2 years from now, or the business is going to be in a state of financial distress 2 years from now. So, based on that logic, the logistic regression has been used rather than the linear classical regression in case of Altman's Z-score model. Now, it incorporates both financial ratios and qualitative variables to assess bankruptcy risk for publicly traded firms, including both manufacturing and non-manufacturing companies. Just I made a mention of the fact that Altman's model originally was targeted towards publicly manufacturing companies. That is one of the fundamental deficiency of Altman model. The outcomes of Altman model in case of privately manufacturing companies and other trading companies are not that robust. That is why one of the fundamental limitation of Altman is that, and that limitation has been overcome by this Olson's O-score model, which has a different statistical base and which also takes into consideration the combination of quantitative and qualitative variables, because we all know as the simple exposure to statistics that the classical regression or linear regression only accommodates variables which is possible to be quantified and expressed in numbers. But there are many variables which are encountered in the business world which are not quantitatively measured. Rather, they are subjective and they are qualitative by nature. They are abstract. They cannot be expressed absolutely in numbers. So, Olson has accommodated those variables also while devising O-score model to predict bankruptcy, and it is equally extended so far as its application is concerned to non-manufacturing companies. Moving further, the technicalities of Olson O-score model is a combination of different ratios, like here there is a mention of the O-score model where the ratios, financial ratios that have been used, that is the log of total asset upon GNP, then total liabilities upon total asset, then working capital upon total asset, current liabilities upon current asset, then the dummy pertaining to the condition where the total liabilities exceeds the total assets. That is a very typical condition in a business when you are having more borrowings compared to the assets you have created by using such borrowings. So, that is, they are all negative connotations so far as a business is concerned. Otherwise, you will come across the opposite orientation where the total asset overrides the total liability. Here we are going otherwise, and if that is the first dummy which is introduced in O-score model, followed by the financial ratio net income upon total assets, then funds from operation upon total liabilities, then the second dummy negative net income. Obviously, there are many companies who are running into losses, they are more likely to go bankrupt and they are more likely to end up in a state of financial distress. If the companies are profitably running and they are continuously generating excess revenue over and above their expenses, obviously they are having less likelihood of bankruptcy. Here we are taking the opposite orientation, that if the company's net income is negative, so indirectly we are talking about loss making companies and their likelihood of bankruptcy, followed by the next ratio, that is net income minus cash flow from operations upon total asset minus total liabilities. So put all these financial ratios together using different coefficients and using the dummy variables in a binary orientation, we are going to quantify the O score by using it, and the technical description of this O-score model is given in this slide. Moving further, after calculating the O-score, as because the statistical background of O-score model is different, that is a logistic regression. So we are there to make use of a logistic function in order to calculate the O-score, and here is the formula to calculate the bankruptcy score, that is 1 upon 1 plus e to the power minus O. So it is a logistic function through which we are there to calculate the final O score, and the decision making criteria is that if the value of P is greater than 0.5, then it leads to a higher likelihood of bankruptcy, and if it is less than 0.5, it leads to lower risk. Here there is a difference. In case of Altman model, the decision criteria are decomposed into 3 subcategories. But in case of O-score model, the decision criteria only specifies 2, that is, if the p-value is greater than 0.5, there is more likelihood of bankruptcy, or the companies are having more probability to end up in a state of distress down the line in short span of time in the future, and if the p-value is less than 0.5, they are having less likelihood of getting into a state of financial distress down the line in the short span of time. Also, there is a difference in the parameter of decisions. If we make a comparison of O score and to that of Z score, here in case of Z score, if Z score is greater than 2.99, we used to say that there is less or there is no probability at the end of the company to end up in a state of bankruptcy. But here when we are talking about the O score, if the value of P is greater than 0.5, we are saying that the companies are having higher likelihood of bankruptcy. So there is technical difference so far as O score model and Z score model is concerned, and they have been used in tandem by the users community as and when they are into the protocol of predicting the likelihood of bankruptcy at the end of the body corporate is concerned. And technically there are comparisons, there are certain loopholes associated with Altman model, there are also certain loopholes associated with O score model. We are not going to discuss in detail with regard to the loopholes or the impediments of both these models and a comparative orientation of Z score and O score model by using different bases of comparison. Here our very purpose within the context of financial statement analysis is to dig out and predict what is the likelihood of bankruptcy, and for that the Z score and O score models are quite handy dealing with the same state of affairs so far as body corporate is concerned. Now with this, the predictive models pertaining to bankruptcy comes to an end. Thank you for your kind attention.